Hello everyone. In this video, we'll talk about the portfolio performance evaluation. So how we can compare the performance of a different portfolio and actually give us a little idea what it actually means and what is this theoretical application or practical application of this performance evaluation measure. So the question is asking the chief financial officer of an investment firm wants you to evaluate your fund manager's performance, which specialize exclusively in European equities. So looking into the last 3 years period, and during the last 3 years period, those are the average return, and those are the standard deviation, and those are this beta of this fund, including that the Euro Stocks 50, which is our benchmark, right? And Eurozone's government bond rate was 3%. The risk-free rate is 3%. What we need to do, we need to calculate the Sharpe ratio, Treynor performance of these above portfolios. And we also need to calculate the CAPM, what is the expected return, and alpha for those fund, and plot the alpha against the security market line, which is interesting to look at. And given this different information, Sharpe ratio and Jensen alpha, which fund manages the highest risk-adjusted performance? So looking into the risk-adjusted performance based on Sharpe ratio and Treynor ratio, and as well as this Jensen alpha. So let's look into it. So I pre-populated those information here. So in your exam, you need to do. You can either do the same table or the way you want. So let's look into these. So let's draw some lines, complete the table. So we're looking into 3 different measures in here. So let's do these. So this is probably for Treynor ratio, Sharpe ratio, Treynor ratio, and Jensen alpha. So we can look at Sharpe ratio, Treynor ratio, and Jensen alpha, right? So we can, however, I think the question is asking to calculate the Jensen alpha in a separate measure. So why don't you just probably delete that. And calculate these the Treynor ratio and Jensen alpha. The Sharpe ratio and Treynor here. And we'll do these Jensen alpha separately. Oh, just get a new one. Let's look into the formula. The Sharpe ratio is also saying, so what's the excess return? So R, let's put it fund. So RI, we can either put P or I. Let's do, because it's fund, let's do RI minus RF divided by the sigma. And the Treynor ratio is the same. Numerator is excess return. The denominator is the beta. Now, these are all in percentage, so we can either put this one as a percentage measure, let's say, or in decimal, whichever you prefer. Now let's do all in decimal to be on the safe. Make it all the same, similar calculation across different questions, right? So Sharpe ratio for P, we can calculate that one is so 0.13 minus risk-free rate. So risk-free rate, if you look at, is given 3%, right? So minus 0.03 and divided by standard deviation, which is 16%, 0.16. And if we do this calculation, this will give us 0.63. And for the Treynor ratio, is the same numerator 0.13 minus 0.03. Denominator is the beta 1.2, and it gives us 0.0833. For Q, this one is 0.18 minus 0.03 divided by 0.22, and this is 0.68. For the Treynor ratio is 0.18 minus 0.03 divided by 1.8, which gives us 0.0833. So the same value as the P. And 0.09 minus 0.03 divided by 0.7, which will give us that one will give us 0.75. And for S, this one is that 15%, so 0.15 minus 0.03 divided by 1.5, and this is 0.80. For the Stocks 50, the Euro Stocks 50, this one is 10%, so 1003 divided by 11% standard deviation, that will give you 0.64. So let's look into the same for R. So same value on the top, and that the bottom part will change it too. So what's the value of beta? 0. Oh, my bad. This is 8%. My bad. This is 8. And this is 0.7, and this will give us 0.8 0.0857, and 0.15, 0.03, 1.3, which will give us 0.0923. Same for the Stocks 50, 10 minus, and this beta is always 1, which is 0.07. So we calculated the part A, which is asking us to calculate the Sharpe and Treynor ratio. Now, the second part is asking us to calculate the expected return F of CAPM. So using the same information in here, so I need to draw this one again now. So let's look into the different fund. So we got a different fund here. And then we're going to have this standard deviation, right? The AV, we need to calculate, to get the information of beta, calculate the expected return. Let's write, take this one is in the top because I want to put this formula for it. So expected return is just the CAPM, right? So RF plus beta, RM minus RF, and the alpha is actually RI minus this, whatever you get these values. So RI minus RF plus beta RM minus RF. So let's put all of this information. So we've got fund, standard deviation, the value of beta, so this is for fund P, Q, let's say R, and we got S. So we need to get the return as well, right? So I think I need one more. So what we can do, we can get rid of these, add return here, and put the value, the fund name probably in here, right? So we need one more. So PQRS. So the return we're given 13%, 18%, 9%, 15%, and standard deviation is 16%, 22%, 8%, and 15%. Beta for P 1.2, 1.8, 0.7, and this is 1.3. So expected return, just plug all these values. RF is already, you have 0.03 plus the beta, which is 1.2, RM, which is 10%. So looking into RF in here, RM 10% minus 0.03. So this will give us 0.114 or 11.4%. And for the Q, so looking into RF is going to be always the same. The only value that will change in here is the beta. So 0.03 plus the beta 1.8, because it has a higher beta, higher risk, our expected return is going to be higher, which is in 0.156 or 15.6%. And for R 0.03, the beta is lower, so our expected return, so because we are taking less systematic risk, our expected return is going to be lower as well. So this will give us 0.079 or 7.9%. For S, this is higher than P, beta, but the lower than Q. So we expect a return in between 11.4 and 15.6. So that one will give us 0.03 plus 1.3 is the beta, 0.10 minus 0.3. And this is 0.121, which is 12.1%. Now, let's look into how they are different. What's this difference between our expected return and actual return? So this is actual return, right? Which is RI. So RI, so 13 minus, so this is 13% minus, or you can just do this one in percentage as well, up to you, 0.13 minus 0.114, which will give us 0.016 or 1.6%. Or we can just do in terms of percentage. So 18% minus 15.6% is 2.4%. And that one is 9% minus 7.9%, which is 1.1%. And this is 15% minus 12.1%, which will give us a negative 2 point and not negative, sorry, my bad, I'm saying negative 4. So these are in percentage, so this will give us 2.9%. Now we have all of these values. What we need to do, we need to calculate the security market, not calculate, the draw security market line. Let's see if we can just make it a bit smaller probably, and then resize it. So there we go. So we can actually draw the graph here. So what do we have? We need to, for security market line, so you need to put beta and the return. So let's say this is the beta, x-axis is the return, sorry, y-axis is the return, x-axis is the beta. So this is beta and this is return or expected return. I'll just say return. So if you're looking into, let's just do in between, maybe in here, this is 10%. And in the middle, let's say this is 1. Now let's say what do we have here. So if you get this is 1, this probably will be 2. So let's say this is 2 and this is 1. So let's plot P. So the P, we need to get expected return. So if this is 10%, we need to have an intercept as well. So this is 5. Let's say it's 2.5. So this is, let's say, is 3%. And let's plot 1, then you'll get all of these. So 3%, and if we are looking into the P, our expected return is 11.4, whereas the beta is 1.2. But if you want to get these 1, so let's say we've got 1.2 somewhere in here. So this is 1.5. So this is 1.2. Let's say 1.2 here. So when this one is 1.2, we are looking into something 11.1. So let's say this is, let's say 10. So this, if this is 20, this is 15. So 11.1 somewhere in here. And this is the intercept, right? So we are looking at a line going through this. So this is 1.2 and this one is 11.4%. This is our expected return, but actually we got 13. So this is, we've got a little bit up here. And this is what my friend was looking into, the beta, which is 1.6%. And this is for P. Now let's look into for Q. So the Q is 1.8, so very close to here, 1.8. And when we have the beta of 1.8, 1.8, our expected return is 15.6%. So 15.6, let's say somewhere in here, right? So let's say somewhere in here. So this is 15.6%. And the actual return of this one is 18%. So if this is 20, so somewhere in here below that. And this is the difference between 18 and 15.6 is 2.4%, right? So this is Q. Now look into R. We have R beta 0.7. So if this is in the middle 0.5, so looking into 0.7 in here, when you have this 0.7, we got expected return 7.9. So if this is 5, 6, 7, probably here somewhere. So let's look into different color. So this is 7.9. So this one is security market line is actually plotting the expected return based on the CAPM in beta and return graph. So this is 7.9, but the actual return is 9%. So actual return is somewhere close to that. And the difference of these is 1.1%. So this one is the alpha. And the last one, we got the beta 1.3. So they're very close in here. Probably a little bit here, probably. Just write a different color. Then let's do black. So 1.3. And when we have this one 1.3, the expected return becomes 12.1. So this is 12.1 is below that. So somewhere in here. Let's put this value somewhere else. So let's say 11.4. And this value is 12.1%, but actually they got 15. So in here, and this value is we got 2.9%. So this is the what do you call it, security market line. In the exam, remember you have to clearly write down what the axis is, the beta and the return, and if you put all of these values and show the value of alpha. Right, so we can easily see anything above the security market line, you can see these are undervalued, and that's why they bought in a cheap price and then got a higher return. So anything here above this is underpriced. Anything down is overpriced. So in our example, we don't have anything overpriced, so everything we have, this one is underpriced. Now let's look into the third question, what they're asking. Third question that they is asking, given this Sharpe ratio and Jensen, which have higher risk adjusted performance, right? So we need to calculate, find out as the Sharpe ratio, right? So let's just do one thing in here. Just put a different fund, and what is the Sharpe ratio and what is the alpha, right? So this is PQRS. If you're looking into the Sharpe ratio of these, you got 6.63, 0.68. So let's say just put those values 0.63, 0.668, and 0.75 and 0.80. And if you're looking into alpha, this has 1.6, 2.4, 1.1, and 2.9. And how we can compare this one? I'll just put it this more probably. This one, this has the higher Sharpe ratio. So if you want to rank it, and R has the second highest Sharpe ratio, and then third highest Sharpe ratio, and then fourth highest Sharpe ratio. But if you want to compare with the alpha, S has the highest alpha, so rank 1. Q has the second highest alpha, so the ranked 2. And then you got P is ranked 3, and the lower is this one. We have R also in here. So if you're looking into the high Sharpe ratio, this as overperformed compared to the and another one, and it performed better in terms of the Sharpe ratio as well, sorry, alpha as well. But if you're looking into for the second place, so we're looking into compare the R is better if you look in the Sharpe ratio, but Q is better when we compare this one with Jensen alpha.